answering your tough financial questions for the past 26 years. It's Allworth's Money Matters with co-hosts Scott Hanson and Pat McClain.
Welcome to Allworth's Money Matters. I'm Scott Hanson.
I'm Pat McClain. Thanks for joining us.
Pat and I are recording from our homes this week. You'll notice that the calls were recorded at a different time from our studio, so that's why the sound quality is a little different, but it's still same great show.
Well, glad you are here. I guess this is the last weekend of May 2020.
Yeah.
What week is this in the shutdown, Pat? I don't know.
This is, I don't know, but this thing, it's been unbelievable, isn't it, Scott? It's just been, and we broadcast from California, and I know a lot of podcast listeners across the U.S. are at different places, but just recently this week, they have now started to allow restaurants to open, and hopefully in the next week, hair salons and ancillary businesses will be allowed to open.
Yep. So anyway, here it's been amazing, and I think obviously it's a financial program, and we'll talk about finances. But Pat, what has been amazing is the stock market. I mean, if you would have told me that the stock market would be really close to where it was at the start of the year,
it's what it's interesting, Scott, is the market's there, but then you take a look at some of the bond ratings on some big, huge companies, and they keep getting downgraded, but the stocks seem to hang in there. It's a perplexing time to be an investor. It is.
And the downgrade, right? The downgrade says, we're not that confident. We're pretty confident they can pay it back, but not. There's a little bit of risk that maybe you won't get paid back.
That's right.
And at the same time, those same companies, the price of their stock, essentially they're equity investors who would need to pay off the debt before they share in any of the profits. Essentially, that price has been driven up. It's really been a strange thing.
It's it has, and we saw Hertz file for bankruptcy this week. We'd expect to see more of that coming up, which puts the rest of the bond market at risk for corporate bonds, because as one falls, the bond market responds to that.
Yeah, and it's so here we are. It's a really interesting time, and I think obviously, Pat, a lot of the reason the stock market is up is people are taking a longer term approach, and it's the lack of alternatives when interest rates are so low, and then it's like, well, if you're going to take risk, do you want to take risk on the bond side of a company, or you want to take risk on the stock side?
So I was looking at that earlier this week, Scott. So the dividend yield on the S&P 500 is about 2.2%. Now, we'd expect that to go down as companies try to preserve cash and lower their dividends. But you look at that, and then you look at, let's say, the 10-year Treasury that's trading at about 0.6%. And I think that's kind of one of the drivers, which is if you're looking for income, do you go to that? Do you go to the almost risk-free 10-year, or do you put a little bit of risk in the portfolio and reach for some yields like on something like the S&P 500? What are your thoughts on that?
Yeah. Well, we've got some calls we need to get to. Let's take these calls and let's have a little more conversation about that. 833-99-WORTH is the number to join us. We're talking with Craig in LA.
Hi, Scott and Pat. Thanks for taking my call.
Hi, Craig. Thanks for joining us.
Let's see. Got a question regarding kind of how to do planning for the Secure Act. Little background. My wife and I are both retired. We're in our late 50s. We have 2 children. Both are in college. Approximately 95% of our current retirement savings are in 401ks and IRAs. We also have remaining pension payments that are coming. They're the form of a 5-year lump sum. So most of that will also go into tax-deferred accounts. Started doing Roth conversions this year, up to or just beyond the 22% tax bracket. But with the death of the stretch IRA, I'm wondering, is there any way to kind of do more so that in the event my wife and I pass away prematurely, the kids aren't stuck with a huge tax bill.
Explain that 5-year lump sum to me.
So the pension plan that we both happened to be in had different forms of payouts, single life annuity, joint survivor, all that stuff. And one of the options was a 5-year payout that the IRS recognizes as a lump sum, at least the qualified portion of it.
All right.
Okay.
Good.
So that rolls over every year.
So
It rolls over every year.
What's the ballpark you have in what are qualified tax-deferred accounts, IRAs, 401ks, once this is factored in?
So today, who knows what it'll be tomorrow, but today it's about $4.25 million in our current retirement assets, and there'll be about another 2.5 still coming in. Over the next 4
you
years.
do have I see why you're calling.
Yeah.
My first thought is your late 50s.
So you've got almost $6.7 million in qualified accounts.
And you live in California.
Once it pays out.
Yeah. So tell your
Are you gonna stay-
children to move to a low tax state. We'll start with that.
So your wife wants to go follow him. Are you gonna stay in California in retirement?
That's the plan.
Do your children live in California?
They do. Yeah, they're attending Zoom University in my house.
All right.
I know the drill.
We've had the discussion about whether the kids should go back to a high-paying college education or a public school.
I saw a bunch of Harvard students signing petitions. They'd rather defer class than do online.
Oh.
It'll be interesting to see how this waits. All right, so
What can you do? And you're doing the 22%. And the question is, do you go higher than
the
that?
challenge is with California.
or anything else, life insurance, accelerated gifting.
Yeah. What assets are outside of this?
This is really rare that someone has over $6 million in retirement plans in their IRAs and 401ks at under age 60.
Yeah, you used to see these with doctors and lawyers in defined benefit plans, but those things have kind of gone away.
You used to play you can play little tricks with them, but you can't so much anymore. But
so what assets do you have outside of this?
About $150,000 in bank accounts and my house, and that's about it.
And how much do you have in Roth?
$250,000.
Wow.
I got nothing.
You got nothing. No, it's an interesting problem because
I like the fact that you're thinking ahead.
yeah, this is. What it's really going to come down to, and here's obviously what you've been going through, Craig. It's like you're trying to look at all the different avenues and then make a decision. Do you do anything at all, or do you go down some path? Which is you've thought of. And my first couple thoughts were, well, do we look at buying some life insurance, and that
Why?
for the taxes that will be due on this. I have as much concern, to be frank, of what taxation may come during your lifetime, and if there is an excise tax on large retirement plans. Because there used to be, back when I started in the industry in the early 90s, it was over 7.
Was it 408A? Was that it?
No, it was if there was a lump sum greater than, I think it was $750 at the time.
Yep.
There was an excise tax on it. So, I mean, the more you can get into Roth, are you retired or still working?
Yeah, retired. We're both retired.
And do you have any taxable income coming in now, or is what you're doing is take the money out of here to?
And funding the Roth, right?
That's it. I mean, I'm spending savings. I get a non-qual portion of my pension is about $100,000 a year.
So that's already
ends in
taxable
2 years
income
as well. Correct.
Scott, what would the purpose be to buy the life insurance versus just paying the taxes out of the distributions to the kids?
Well, if you pass away today, the money's going to have to be, under current rules, taxed within 10 years.
But he only has $150,000 in money outside of qualified plans, so he'd have to take the money out of the IRA to pay the life insurance premiums anyway, which would be in a higher rate, which would negate that. I like where you were going with it, the thinking.
It's really converting. So if you're pretty confident you're going to stay in California, it might be looking at converting even more to a Roth. I wouldn't do anything now. I would wait until November or December to see what the tax situation is going to be like, because one would expect taxes are going to go up.
So what you're saying is,
In California
is
particularly.
go above the 22% rate in a Roth conversion.
I probably would.
I would consider that. I would absolutely consider that.
Okay. How about I read something on this is perhaps modifying the retirement account beneficiaries so that on each of my wife, we basically have about the same amount in our retirement accounts each. So changing the beneficiaries and making my children partial primary on either one.
How did you end up with the same amount? Did you guys work for the same company?
We started the same company. They split into two companies, but they maintained the pension, and
you guys worked for a good company. Yeah.
So the question would be, do you put them as 75% your wife is the primary and 25% the kids?
Something like that.
I probably would.
It's basically,
yeah. Yeah. Well, the first tranche is that's assumption that there's difference in the dates that you guys die.
Right.
I don't see a downside to it.
Yeah.
I only see upside. I don't see any downside to it.
I mean, if in a perfect world, if you can transfer some of your IRA to your kids today, I mean, that would be a brilliant tax strategy. But you can't do that. Yeah. Like if you had another asset, appreciated stock, you could transfer that stock to them. Then they could sell it and be taxed at their tax rates. You can't do that with retirement accounts.
And you'd be comfortable giving your children money today?
I would. Not so sure about the other half. The better half.
Got it.
Yeah.
I like
you
that.
You could set up a specific trust that only kicks in at a death where, and this is something seriously to consider, but this is, again, it's only if you die prematurely. But where you could have it structured so that a separate trust would be created upon your death for whatever portion you want to have go to your kids, and then you could have restrictions on that trust. Money still needs to be distributed in 10 years. The income tax will still flow to them based upon the distributions.
But the money's still going to be distributed in 10 years, so there's only so much restrictions.
But no,
because
you could still have it could still be.
Oh, got it. Go out into a side trust, and the money doesn't get to the kids. That is, so if you were worried about how the children would spend the money, that is absolutely a viable option. And then making.
Craig, is anything going on health-wise where you think that your life expectancy might not be normal?
No.
Okay.
No.
Yeah. So
I mean, if you had terminal cancer or something, we'd say, I mean, this would be a great strategy to employ.
The interesting thing, Scott, about naming the kids as primary beneficiaries on this for a portion of it is that he feels differently about his kids receiving the money than his wife does.
Well,
right? Didn't you say that, Craig? You'd be okay with the money going to the kids today, but your wife would not.
Yeah, we have different thoughts on that.
Yeah, I get that. Then you can have strings from the grave and structure a trust to pretty much provide anything you want.
Okay.
I mean, your options really right now are: do we convert more to a Roth, which you pay more taxes today, and the way that's because it's a progressive tax structure, the more you take out, the higher percent is going to go to the tax man. And you're doing it in both federal and California, which gets pretty onerous.
I assume your house is paid for.
Not quite, but that's almost intentional because I caught the falling sword of an interest rate back in the day, and I got 2.625.
Got it. Yeah, there's no hurry. I think you should spend more money. That's what I think.
Well, I can't leave my house.
That's in Los Angeles. Yeah.
Okay, well, when this
and if you're on the beach, you better keep walking.
When this passes, I think you should spend more money. Truly, I think you should spend more money. That's
okay.
And you can't do any qualified gifting to charities until you're 72 now.
Yeah.
You could take money out and gift it to a charity. That's going to reduce, but I don't think your objective is necessarily to reduce your estate as much as it is just
reduce the taxes on the estate. All right, there's a couple ideas for you.
I'd look at converting more to a Roth and just see what you're comfortable with there.
Great job saving, by the way.
You could also leave California for a couple of years and convert more.
I do have a question
come back
for
to
you.
California. In all seriousness, if you moved to Texas for a few years and converted, or Nevada, and converted a few years worth of your IRA to a Roth during those years, you're residents of that state, you will avoid that state income tax. Then you can come back to California, where that has the highest marginal income tax rate in the country, and that Roth is going to be free from that taxation.
That's not a bad idea. Just out of curiosity, personal question.
And you factor in what it, I could pay for second place.
So, just out of curiosity, what kind of cars do you and your wife drive?
My wife has a Honda Pilot.
And you drive
and I have an Audi.
Okay.
Pat
was
That
asking.
was my retirement present to myself.
What were you driving before the Audi? I mean, the.
2010 Nissan Maxima.
Okay.
There we go.
Thank you.
Thomas Stanley wrote a book years ago called The Millionaire Next Door,
Yep.
and you are it, which is not a pretentious display of wealth, but good savers.
That's right. There's oftentimes,
investors.
it's funny. I appreciate the call, Craig. I was talking to a guy at at the Mercedes dealer, and he says, "You wouldn't believe." So some people have the money to afford the cars. You would not believe the financial situation of some of these people that lease these cars. The kind of stuff, maneuvers they go to get that car.
Big hat, no cap.
Oh yeah. Anyway, glad you called, Craig.
And let's talk to Joanne. Joanne, you're with Allworth's Money Matters.
Hello, gentlemen. Good morning.
Good
How
morning,
are
Joanne.
you?
We're doing fantastic.
Great. Well, I have a question for you that's just recently come up in my life. I'm a 26-year veteran of the Postal Service, and I was going to retire this month, and then COVID happened, so I thought I would maybe wait a while, but now you may have heard the post office is struggling. They anticipate we could be out of money by the end of the summer, and I know that the president wasn't going to allow us to have any funding. So my concern is I have about $743,000 in my TSP. If somehow my postal pension were to go away, and with the reductions that might come in Social Security, do you feel that I have saved enough, or would I be smarter to, just keep working, because who knows what the future is going to hold?
How much would your monthly pension be if you retired today?
Well, I'm supposed to get just under $1,500, but with taxes and my insurances, I'd have about $600 a month clear out of that.
And how old are you?
63.
And do you qualify for Social Security as well? I know Post Office has their own kind of unique postal and railroad.
Right. Yeah, I'm FERS, so I get the Social Security, a small pension, and then my TSP. So I would get Social Security. If I wait till 66 and it's at the same level, I would get 2183. If I took it now, I would get 1768 a month.
Can you afford to retire? Have you done the math?
Well, I was hoping that I was going to be able to live on about $50,000 a year, and I had been talking to a couple of different financial people who had told me that if I came out with about $670,000, that I would be okay, for my retirement. But that's assuming I'm going to have these other things in place.
I wouldn't, Scott.
I would not worry about losing Social Security
or your pension.
Yeah.
I wouldn't. I'd worry
If
more
your
about
pension
getting
was-
struck by lightning.
If your pension was $150,000, then I would have some concern it could be reduced.
But at $1,500 in your age and your years of service,
I really would not have any concern about that.
at all.
Okay.
And you've accrued
All right.
that, by the way. They can't go back and claw back from you what you haven't already accrued. They can change the rules going forward.
I mean, there's talk that Social Security is now scheduled to run out of money in 2029.
Scott, I would make a different argument that the Postal Service may end up treating this like major corporations do and offer you a buyout or an early out if you leave early, which would in fact either enhance your benefits or provide you a payment to leave.
Okay, well, I was just concerned if they did ultimately privatize us, which,
It still wouldn't
guess
affect your
could
benefits.
happen.
It wouldn't
It
affect
wouldn't.
you.
Okay.
It would not affect
Nope.
your benefits.
Nope, those are locked in guaranteed.
So if you were sitting in any of our
if your
offices,
pension, like I said, if your pension was 150 grand or two, and you're also federal government, you're not a state or municipality.
if you were sitting in one of the offices with any of our advisors, the question we would drill into is, do you want to retire? Do you have enough to retire? We wouldn't spend any time worrying about
Not
your
for this.
pension
Not
going
in this
away.
situation.
In
Other
this-
situations we might, but not this one.
Not this one. So don't let that
And
be a
I
driver.
I wouldn't be in a rush to retire, as Pat was kind of alluding to. I'd be curious to see if there's going to be some sort of buyout for retirees.
What fundamentally needs to happen in the Postal Service is a restructuring of your offering, which includes, and
6
should
days
not
a
be
week.
limited,
Maybe.
5 days a week, 3 days a week.
Yeah.
If you want it daily, your business, and you pay a little bit more to actually have it delivered, that's what really needs to be happening.
Of course. And
but
you don't need a post office every 4 miles in some of
Yes.
these towns. But
Right.
but that's a different story
Yeah.
altogether. But you shouldn't worry about that. So
and unfortunately, I really think it's the mismanagement of Congress over the years that's put the Postal Service in the situation they've done. They haven't adapted with the times.
not the workers, obviously.
No.
So,
Joanne's put in 26
Joanne,
years.
you shouldn't worry about that. If you want to retire and you have enough money to retire. But if you want to stay on a couple more years, I wouldn't spend a minute worrying about your pension going anywhere.
I really wouldn't, Joanne. And
Okay,
if
I
you're
can
talking to
sleep
good,
again.
are you talking to good reputable advisor, certified financial planner, that sort of thing?
Yeah. Oh, yes.
Good.
Yes. As a
Yeah.
matter of fact, I've been talking to one of your people. I haven't hired
Oh,
him yet, but
okay.
yeah, that's what we're planning on.
We would hope to include our advisors in that reputable side of it. But you shouldn't talk to any advisor that's trying to scare you into retirement.
Yeah, no, I hadn't talked to him since all this pandemic has come down. I've just been letting my stuff sit there. I'm not touching it. I'm not adjusting it. So.
Yep. As long as it was a good allocation going in, you're fine.
Yeah, appreciate the call, Joanne. Wish you well.
Let's head to Cincinnati. We're going to talk with Brent. Brent, you're with Scott Hansen and Pat McLean, Allworth's Money Matters.
Good afternoon, guys.
Hi, Brent.
What can we do for you?
I've been with my employer about 18 years, and I enrolled in the 401k, the day I got there. And it's a national plan sponsor. You would certainly know the name, but I've been dissatisfied with them for a multitude of reasons the whole time. And most recently, it kind of had a final straw where they, quote, misplaced my beneficiary, and I found out I'd had no beneficiary on the account for like 6 years. And I'm really dissatisfied with them, like my employer. And I'm literally 59 and a half, so I know I could just pull money out of there and pay tax and not the penalty.
No.
You could transfer it to an IRA.
You could roll it over to an IRA. You don't have
I can
to pull
do it right now and stay employed. I don't have to.
Yeah, in-service distribution.
I thought that was on.
Yep, 59 and a half.
I'm sorry, the term in-service distribution?
Yeah, or in-service rollover.
In-service rollover, I think, yeah.
Yeah, you're 59 and a half. If you were 58,
so I can.
different rules.
So if I stay employed, which I hope to do,
yes,
and I do this and I roll that over, then at the end of every year, of course, I want to continue to capture my company match and so forth.
Yep.
Then at the end of every year, I could just do the same thing.
So tax law is clearly going to allow for it. What could happen is that your employer might restrict a match for a period of time if you do this. I've seen that. It's not a requirement by any means.
I've seen one where you have to keep 20% of it there and you can roll out 80%. Every plan is different. Tax law allows you to roll out at 59 and a half into another IRA. So let's just say you used a big firm, started with an F and ended with a Y, and you're dissatisfied with them, correct?
Yes.
Okay.
Okay. Only because they're the number one provider.
It's not them. It's actually, since I didn't say a lot of the negative things I was going to say, it's Prudential.
Oh, it is Prudential. Oh, they're a big player in the 401k space too.
They're not very good at it.
Player. Well, listen. Part of living in America is that you can come on a radio show like this and actually say what you think. You should call or talk to the plan provider and find the rules in terms of disqualifying you for the match, but they're pretty light at age 59 and a half. So the ones that we have clients that are in similar situations, we'll go in there once a year and scoop out whatever the dollars are and roll them out. Sometimes they require the match to stay in or the dollars to the match
Not
to
always,
stay
though.
in, but not always. So yours is easy. You can pick out any IRA provider you want, trustee, and build any portfolio you want and roll it out tomorrow and just find out how much you're allowed to roll out every year without affecting the match.
And you would recommend that person who administers the plan within my employer or at Prudential?
Oh, I'd talk to the plan administrator internally.
What you're trying to do is figure out your employer's rules, not the administrator's
It
rules.
is actually in your document. So if you look up the documents of the plan, you could actually read it yourself. It'll be right there. So in the summary plan description, it normally has these in the summary plan description. So if you go into the company's website,
Which
and
they're
look
supposed
at
to make available to you on
an annual basis.
or
So
something.
if you go in and read the summary plan description, you'll get to it pretty quick.
Fantastic. Best news I've got this week.
Good.
Guys.
Well,
Thank you very much.
I hope your week gets better.
Yeah, that's right. Yeah. All right. Wish you well, Brent. And,
Thank you.
All right, we're going to take a break, and Pat, as you had mentioned, we'll talk a bit about the dividend yield on the S&P and some other great stuff. So stick around for more of Allworth's Money Matters.
Can't get enough of Allworth's Money Matters? Visit allworthfinancial.com/radio to listen to the Money Matters podcast.
Welcome back to Allworth's Money Matters. Scott Hansen.
Pat McLean.
And again, we'll take calls here in a moment, 833-99 Worth. Yeah, I think there's lots of people with questions in the midst of
Yeah.
this time.
So we have an upcoming event, a virtual, if you will, event about how to navigate this marketplace and your personal finances. And so Scott is doing it from the comfort of his home, and I'm doing it from the comfort of my home.
I think it was comfortable before the older kids came back, wasn't it?
Oh my. One of mine did leave this week, which to go back to his college apartment. So I don't know what it looks like there, but I love him a lot, and I'm glad he's gone.
It's this Tuesday, this coming Tuesday, the 2nd of June, 5 p.m. Pacific, 8 p.m. Eastern. And it's essentially about a 30-minute webinar, how to be a bull in a bear market. And we're going to talk about some tax loss harvesting, how that works, and some strategies around that, and how to take advantage of, maybe get some sore spots in your portfolio that you can maybe at least have it help you with some taxes. We're going to look at Roth conversions and the tax strategies around there. We're going to talk a bit about 401ks and also a mortgage refinance. So we have a lot of information in about a 30-minute webinar. And if you want to be part of that, it's a live webinar. And we did one on last Thursday, which went really well. But to be part of it, it's go to allworthfinancial.com and it gets you the information. Pat?
And it's interesting because it's interactive. You can actually ask questions through the workshop, and we'll get to your specific questions just like we do in a public workshop. But this is it's all new to us doing these just because the environment has changed, and that's what we're doing it. But let's talk a little bit on the radio show, Scott, about tax loss harvesting because the emotions involved with tax loss harvesting are pretty strong because it requires you to actually say, okay, this particular security or exchange traded fund or mutual fund has lost money, and I'm going to recognize that loss and buy something that's very similar but not identical, and use it as a tax strategy as well as an investment strategy. And if one of the things that we see people do a terrible job in their own portfolios, and this is obviously outside of an IRA or 401k, is how they actually manage tax loss harvesting. So on that workshop, we're going to spend a few minutes talking about that.
Yeah, and I think a lot of it, the example, Pat, is let's say you own United Airlines, which has got hammered, obviously, and you think, well, I don't want to give up on the airline industry. I think I'd like to still hold a position. You might sell United and then immediately purchase American Airlines or Delta Airlines, something similar, right? That's kind of the concept. Or if you own Wells Fargo and instead you sell it and you buy Bank of America.
Yes. Yeah.
That's the kind of strategy behind that.
And then, and you say, well, I want Wells Fargo. Well, you wait 31 days and you buy back Wells Fargo in your portfolio.
Yeah, you can. Yeah, you have to. If you don't wait 30 days on either side, it's considered a wash sale and doesn't trigger the tax on it. But it's something to look at in your portfolio, particularly in times of volatility. And although the broad indexes are higher, Pat, there's still some individual stocks that are way down, and some ETFs and stuff that are still way down from where they were.
Almost certainly. And it's quite frankly, it's what we do on a regular basis with our clients' portfolios is we dig into the tax loss harvesting. And that's, if your financial advisor's not doing it, then you need to have a discussion with them.
Yeah. To join the program, 833-99-WORTH. We'll get you on the air here, 833-99-WORTH. We're talking with Larry. Larry, you're with Allworth's Money Matters.
How you doing, guys?
We're fantastic, Larry. How are you doing?
Good. My question today is about the 2020 charitable contributions part of the CARES Act. I was thinking that this was going to be a real benefit to me, and I don't see it as much as what the hype kind of initially was for it. It kind of said that we were going to have that it was not going to. There was no limit on how much you could contribute now, and it was going to help you on your taxes a little more.
So what were you trying to achieve?
Well, what I was thinking was that I'm not able to itemize my deductions, and I guess I was hoping that which means a lot of my charitable contributions do not benefit me from a tax standpoint.
How old are you?
And I am 60. I just retired about a year ago.
And how much would you like to give on an annual basis?
Well, I typically give between $4,000 and $5,000 a year.
And what's your income?
And I don't have any medical deductions. I don't have a home mortgage. I don't have.
Yep. Are you married?
Job. Yeah, we file jointly. So we get $24,400 on the standard deduction. So.
What's your family income? In retirement,
in retirement, we make combined. My wife and I make right around $100,000.
So one thing
I make a six. Go ahead.
If you have the cash, one thing you could do, and this is a strategy that a lot of people employ, that I do take advantage of the strategy, is you could set up what's called a donor advised fund, and a lot of the big firms, Fidelity's got one, Schwab's got one, and it's almost like your own family foundation, right? So what you can do...
In fact, you can name it anything you want.
Yeah.
You could call it the Tom's Family or the Larry's Family Foundation. So you could call it Tom, but it wouldn't make any sense.
And here's how this works. You put the money into the fund. And you get you're able to deduct that year what you contribute. But you don't have to give it to the charities that year. You can dole it out over a period of time. So as an example, you could say, I'm going to contribute $20,000 to this fund in 2020. Then, once the money's in the fund, you can distribute $4,000 to $5,000 a year over the next 4 years to your charities. So what you've done is you've bunched, for your own personal tax planning, you've bunched your contribution into one tax year. But for the charities, you probably... in all likelihood, you probably don't want to give them all the money at once because then they'll spend it and they'll come back to you for the next year for more. And you'll say, wait, I just gave you 4 years worth. And they're like, well, that was yesterday. This is today. Come on, Larry, cough it up.
So to take that one step further, do you have a brokerage account outside of an IRA or 401k that has any appreciated stocks or mutual funds in it?
Yes. Yes, we do.
So take it one step further and you actually gift those to this charitable account, right? And you get a deduction for the face value and you never actually recognize any of the gain on it. So if I was your financial advisor sitting down with you, we'd say, okay, let's first of all determine how much we should give and then what we should give. So you might decide that you have, a bunch of money in cash, that you decided this year you're going to gift $50,000 into a charitable.
Or maybe it's in Procter & Gamble stock or whatever, right? I mean, maybe you've got we don't know your overall situation, but.
And you say, well, Pat, I didn't really want to sell that stock. I could turn around and buy that stock the day I give it away and move my cost basis up. At the same time, giving the same amount of stock to a charity. So
I see.
What you were benefited by this CARES Act. You were benefited with the proper tax planning.
And that is part of the CARES Act, all this that you just described?
Well, the limits are.
The limits on what you can contribute, because it used to be capped at, still appreciated securities is capped at 30% of your adjusted gross income, but cash assets above that is up to 100% of your income.
Where it used to be capped at 50.
60. It was 50, then the last act changed it to 60. But
you can use a combination.
This is a great planning year for you, Larry.
Yeah. Yes. Absolutely.
You've got a number of options, and something like this is these charitable donor advised funds are perfect for someone like yourself.
I've used one for the last 20 years. 20 years?
Really?
Yeah. How long have you
had
used
one? Probably close to it as well. Long time.
And it gives money. Giving money to charity makes it even easier because you don't have to even write a check. You just go online and put in the tax ID number, and it fires it off.
Most of the time, it'll find you just put the charity's name in there, and it pulls it right up.
It makes it so easy. In fact, once you do it, the only thing is, like, if you go to every church Sunday and they pass the basket, you don't throw the envelope. You don't get to throw it in an empty envelope and pretend.
All right, I can get away with that. I can be good with that.
But the nice thing about it, so it sounds like you want to be good stewards with your money. You want to participate by giving some money to your charities, and you want to do it over a period of time. And because you're thinking, I don't want to give it all at once. Because the reality is, if you give it all at once, they still have needs the following year, and you want to be able to be there to participate and help in those following. That's what these accounts are designed for.
My wife and I fund ours about once every 4 years, and then we dole it out to charities.
That
depending
perfect.
on what's happening, and
correct. And I used it as a time to rebalance my portfolio as well.
Give some appreciated securities.
Wow.
Right. So
that is a great idea.
A good advisor, you might want to go it alone. Or you might want to actually get a good tax person or a good advisor to help you.
Well, I would at least run this by some other people before you pull the trigger on it. But
and I actually mentioned this to my financial advisor, and she didn't have a whole lot to say. So I probably will go back with this idea to her and see what she says.
All right. Actually, so you should ask her for the clip off this. Anyway.
I will.
Good luck.
I definitely want to.
Okay.
Well, thank you so much. This was a great idea. I appreciate it.
All right.
I appreciate
good planning opportunity.
Appreciate the call, Larry.
Thanks, Larry.
Thank you, sir.
Bye.
Now we're heading to Colorado talking with George. George, you're with Allworth's Money Matters.
Hi, Pat and Scott. Thank you so much for taking my call. Longtime listener, first-time caller. My wife and I really enjoy listening to your podcast every Saturday morning. So
thank you.
You guys do a great job, so really appreciate it.
Hey, thank you, George. Appreciate that.
So my question revolves around a plan that I have. I have a deferred compensation plan. I'm 1.5 years into the 15-year plan. It distributes.
So this is from a private. Just for clarity, this is from a private company, a non-qualified deferred compensation plan.
Yes, it is.
Okay.
And they distribute the money quarterly to me. However, during the distribution event, they pretty much just take it out of, in a proportional amount, out of each asset class.
Okay. So I mean, for further clarification, so while you were employed, you deferred a portion of your compensation, and for the rest of you that are listening to this, some companies do this for their executives. The tax benefits are a little quirky on it, but it can kind of work like an additional 401k with some additional restrictions. And part of that restriction is once you retire, you have to elect a distribution and cannot change that. And George, you're 1.5 years into your 15 years of retirement distributions. Is that right?
Yeah, that is absolutely correct.
And some of them have restrictions on that you have to set the allocation at the date that you retire and cannot change that. Does yours have that restriction?
No, I can change the allocation as much as I want.
Okay.
What I cannot do is tell them which funds to distribute funds.
Got it. So it's
from.
pro rata.
Yes.
Okay.
And so the challenge that we have now my wife and I plan on living off of this distribution for the next 13 and a half years. And so I'm trying to figure out, my question is looking for some advice on best way to allocate that money. I'm trying not to suffer too much from sequence of events or sequence of returns issues. And I don't want to be too conservative because I got inflation I got to worry about.
So let's in order to do that, one of the ways is that you could go back and adjust your plan in the deferred compensation with every distribution on every quarter.
So in other words, if they force a pro rata and you're thinking, I don't want to sell stocks when the stock market's down, if the next day you went and did a reallocation, rebalance your portfolio to the same allocation, you get to the same place.
You'd get to the same place. So as an example, let's say your portfolio was 50% stock and 50% bonds and cash as an example, and they send you $10,000 every quarter, then the very next day you would go back and you would actually rebalance the portfolio to get to 50-50. So you would actually be selling bonds and buying equities.
$5,000 worth in this.
$5,000 in this situation. Or you could do it outside of the plan in order to actually see what your allocation is.
The bigger question, I think, George, is what should your allocation be, right?
And is it square across all the assets, including the money in the non-qualified versus money in IRAs or 401ks or even outside of that? So let's talk about this. Let's talk about this.
Because pushing Pat's argument further, let's assume let's assume this is year 15, and they send you a check for $10,000, whatever the number, we want to make it up. And you're like, doggone it, I don't want to sell that stock position I'm forced to sell. Well, that same day, if you had an IRA or 401k, particularly an IRA without any tax consequences, you could say, I'm gonna go ahead and inside that account, I'm going to sell some bonds and buy some stocks to keep my overall family allocation the same today as it was before the distribution.
Oh, I see. Okay.
Right. Let's take it one step further. Do you have money outside of IRAs or this non-qualified deferred compensation, like in a brokerage account?
Yeah. Oh, definitely. Yeah. This is just one aspect of it, go ahead.
Do you think you're going to spend all your money in your lifetime?
It's hard to tell. We're funding our long-term care. So depending on how bad things get, we may not have anything left. So I don't know. I don't have a crisp answer for that.
So in a perfect world, we would have all of our stock exposure, equity exposure outside of my retirement accounts and all of my bond exposure inside the retirement accounts in a perfect world. And the reason because of the tax nature. Right. Because if let's say I bought the S&P 500 in my brokerage account outside of an IRA and I needed that money and I sold it, I would actually get capital gains rates versus having a bond in there where the rates would not be quite as favorable.
Give us a ballpark of how much you have in that deferred comp plan versus retirement accounts versus cash money outside.
Within the deferred comp, it's $1.3 million. Outside is 3.5.
And how much in IRAs?
401k is about 900. The other funds probably about 2.5 in IRAs.
Okay.
The rest is in cash and short term.
So you have about $1 million outside of the according.
I mean, one could argue that you just have your deferred comp be, if not all bonds and cash, or mostly bonds and cash, and be that much more aggressive on your other accounts.
Yeah, we've been historically very conservative. Maybe to a fault.
So what percentage of the portfolio do you think you've had in equities? And by the way, you can be as conservative as you want if it achieves your objective.
Right. So outside the deferred comp, I've got about 41% in stock, U.S. stock, about 5% in international, and then the rest in bonds, short-term bonds.
That's not all. I mean, that's not all that conservative.
How old are you, George?
57.
Okay,
you may be a little bit too conservative.
But that feels good this year.
Hey, look at how could I argue with you how much money you've saved for retirement, right?
And how about what's your allocation in your deferred comp?
The deferred comp is quite a bit more conservative. It's sitting at 44% cash, 20% bonds, 25% U.S., and then 10% international.
I don't know if I'd worry about anything.
I mean, one could argue, from a textbook standpoint, could run a model which would argue that you should have, that I wouldn't have any stocks in the deferred comp and increase your stock exposure in the IRA. The challenge with that is when we are emotional people, we're not always 100% rational, particularly when life feels scary and we feel in danger, which is what happens when our stock prices go down, right? That's the reality.
Right.
And so we tend to react and not always. So the concern about if we made a hard argument to say, get your deferred comp plan 100% out of stocks and increase your stocks in your IRA, now it's 3 years down the road. Let's say we have even a worse bear market and the stocks are way down. Now you're looking at your statements thinking, oh, crud, when my deferred comp runs out in 10 years, what happens if my IRAs, there's nothing left? And then you have there's a chance you can make a wrong decision there. So,
but is it 100% perfect? No, but
we don't know what 100% perfect is.
But it's pretty good. It's pretty good. And don't ever let good be the enemy of perfect, right? This is pretty good.
Right.
Right. There's nothing you've said here that really bothers me.
No,
The only thing I would do is make sure that I rebalance these on a quarterly basis in everything that you can to make sure that you're not actually selling or lowering your equity exposure in the marketplace. And this is going to require, when you do this, sometimes to actually sell bonds and buy stock in a bad market. Right. And at the same time, it's going to have you sell stocks and buy bonds in a good market. When I say market, equity market, but you're 57 years of age. You've got 33 years, at least 33 years, if you've got a normal life expectancy between you and your wife, that one of you is going to need to live off this.
Right. Yeah, that's really good advice. I was pretty much just tunnel focused on the deferred comp, never really thinking about the outside stuff.
No, and how are you funding the long-term care? Are you doing it with an asset-based life insurance policy?
Oh no, just with the numbers that I just told you guys. That's
how you're going to pay for it.
It was just
good enough.
Yeah, self-funded.
You should be able to with these dollars.
Good enough. Yeah, good enough.
You know, that's funny. It's long-term care insurance is so expensive anymore. I think the sales of long-term care now the policy is about 10% of what it was 15 years ago, just because the insurance companies
they lose money on it.
But if you've got enough assets, all right. Usually you go into a long-term care facility if it's your last trip, right? And right. And unfortunately, and you've got enough assets, you could go long way more years than you'd want to, right? Statistically, you're in great shape. It's the people and if you have no assets, then some government program will take care of you. It's the ones in the middle that it's a bit most challenging.
And the reality is on the backside of this, the way we see long-term care. In fact, Scott and I were just talking about it before during our break about how long-term care, the nature of long-term care is going to change. That the institutionalization of long-term care.
Based upon what's just happened.
With just what's happened.
Right.
It's going to change.
Who would want to send their loved one into a long-term care facility
I have a friend that works for a Place for Mom, which is a placement agency for long-term. This is completely off the subject for George, but for their placement agency for long-term care facilities.
How's that business been impacted?
They have been laying people off and furloughing because people are not entering long-term care facilities for many, many reasons. And whether it ever picks up again, or whether you just decide that you're going to actually somehow decide to take care of your elderly relatives at home.
It's a strange time.
So anyway, George, we think you've done good. Just put together a disciplined approach, decide what your equity allocation is, and then stick to it. Be good and bad.
And whether you do a quarterly rebalance, and did you say something about sequence of withdrawals?
Yeah,
you don't need to worry about that.
Yeah,
it's an important thing to know for some people. You don't need to worry about that.
Okay,
you're okay.
Okay. Why don't I need to worry about that?
As a percentage of your portfolio, you're not going to affect the allocation.
The majority of your accounts, you're not even touching.
Yes. Okay, I got it.
If you had $800,000 and were taking a distribution on it, then you might have some concern having a bear market and a bad returns your first 5 years in retirement.
So you're taking out what, $50,000-$60,000 a year out of this deferred comp?
Yeah, about 75.
Okay, so it overall as a percentage, it doesn't have that big of an effect on a portfolio.
Yeah,
of
when
the
you
size.
look at the size of your portfolio, it's a very small percentage.
And a rebalance is going to get you there anyway.
You're in good shape, George. Don't worry. I wouldn't worry about long-term care. I wouldn't worry about the sequence of what. Right? I wouldn't worry about any of that stuff.
You just worry about enjoying yourself and spending the money.
Yeah. Okay. No, that's good to know. Thanks, guys.
All right.
Really
Thanks, George.
appreciate it.
Thanks for calling, George. Appreciate the call. Yeah. It's always, it's funny. It's
57 and retired. I'm 57. Does that mean I should retire? I don't think my family would appreciate it at all. I don't think I'd appreciate retirement. Some people are built different.
Yeah. Well, and
he may not be retired.
Right. That, and some people have the luxury of having different kinds of work. Some people don't have that choice.
Oh, that's true. Yeah.
It's like companies restructuring. You're no longer quite needed here. Maybe it's time for you to move on, and all those other things that happen.
That's true.
Or sometimes the job is just so demanding.
You just get tired of it.
Yeah. I mean, you've been fortunate.
I have.
You've been able to kind of control your own schedule. And
I have been very fortunate.
You've got some commitment on a Wednesday that coming week. You can make sure your schedule is such that you can make that commitment and those sort of things.
Yes.
Anyway.
You're right. Plus, I don't know if I could spend that much time with myself if I was retired.
Well, unfortunately, Pat, we are about out of. Oh, you know what? We were going to talk more about dividend yields on the S&P.
Oh, that's right. That's right.
So I'll have to wait next week because we're out of time. But just because some paid a dividend in the past, Pat, does not mean it's going to pay a dividend in the future.
You would expect that these the yields on dividends will come down. That would be an expectation.
Companies have to suspend them for a period of time. So anyway, we are out of time. It's been great being with you. Enjoy the rest of your weekend. We'll see you next week. This has been Allworth's Money Matters.
This program has been brought to you by Allworth Financial, a registered investment advisory firm. Any ideas presented during this program are not intended to provide specific financial advice. You should consult your own financial advisor, tax consultant, or estate planning attorney to conduct your own due diligence.